Good morning, everyone. Thanks for joining the weekly research morning call. Today we have some stock counter updates, followed by the Euro Singapore weekly. Apologize that Ding is on reservice today, so there won't be any technical analysis. Yeah, so without further ado, I'll hand over to Igben for NVIDIA. Igben, please.
Thanks, Mel. I'll be presenting on NVIDIA's 3Q25 results that they recently released. So their 3Q25 revenue beat their own guidance by 8%, and their revenue and PATMI met our expectations. PATMI was up 109% year on year. Within their revenue segment, the largest segment is data center, and hyperscalers make up around half of their data center sales, and the other half comes from enterprises and sovereign nations. As for their positives, we think that um, Blackwell RAM will generate revenue from fourth quarter, 4Q25 as guided by them, because it just started production and NVIDIA expects its revenue to exceed their previous estimate of quote unquote several $billion. Yeah. And second positive we see is that the demand for AI products far outstrips the supply. For example, the H200 Hopper sales increased to double-digit billions, and this is the fastest product ramp in the company's history. And NVIDIA guided that its demand will continue at least until second half of next year. Yeah. As for their negatives, we think that there are some potential impacts from possible trade tariffs, because previously the escalation of the US-China trade war in 2018 caused NVIDIA stock price to fall by more than 50% from its peak in October 2018. So we do think that if similar tariff policy were to be imposed again, there may be material impacts on its stock prices. However, we do think that the impact of these trade tariffs will be less severe as compared to previously in 2018, because currently the revenue from China makes up 13% of their 9-month revenue. And this 13% is significantly lesser than levels in 2018, because for their FY19 revenue from China makes up 24% of their FY19 revenue. Yeah, so currently there is significantly less geographical risk from China. Yeah. As for our outlook, we do expect that the Blackwell RAM will contribute materially to their fourth quarter revenue materially. As for their gross margins, the gross margins are slowing because of the initial Blackwell RAM, and NVIDIA also guided that there will be higher costs in the data center as during the initial RAM of Blackwell. And we do expect that revenue and PATMI growth will slow after the shipment of Blackwell products. Yep. As for the Rule of 40, they far exceed our threshold of 40%. As can be seen, their 3-year average revenue growth is 70%, plus their EBITDA margin 68%. It makes up 138%. As for our buy call, we downgrade to accumulate, and we raise our target price slightly from $155 to $160. And the reason for the downgrade is mainly because of the share price movements. Recently, it has been up quite a lot. Yep. And we raised our revenue and PATMI by 5% and 7% respectively to reflect the Hopper and Blackwell ramp up. Next slide, please. Yes. I'll be presenting on C Limited on behalf of Helena as she's on leave. For C Limited, they released their third quarter results. Their revenue is expectations, but they miss PATMI because they pump in high sales and marketing spending that aid into the profitability. And the revenue growth is driven primarily by Shopee growth, because Shopee had a 43% year-on-year growth in revenue. As for and also because of the growth in C-Money revenue, because C-Money generated 38% year-on-year growth in revenue. As for positive for Shopee, they have returned to profitability because there's a very strong growth in gross order of 24% year-on-year, and as well as their GMV with a growth of 25% year-on-year, and this pushed them to profitability after many quarters of losses. As for C-Money, it is picking up speed because they delivered a robust 38% year-on-year revenue growth, and this is supported by a loan book growth of 73% year-on-year and a stable NPL ratio of 1.2%. As for as for gaming user trend are positive, and Garena showed that bookings rose 24% year-on-year, and some of their key user metrics, including quarterly active users, had a year-on-year growth of 16%, and their quarterly paying users had a year-on-year growth of 24%. As for our outlook, we do see Shopee having uh having a mid-20s GMV growth in FY24 because they have enhanced their monetization by increasing commission and ad take rates. As for Garena, um, we do see there's momentum within Garena because of their Free Fire's user base growth, as well as bookings to achieve a 30% year-on-year growth in FY24. As for the Rule of 40, adding together the 3-year average revenue growth and EBITDA margin, it is below the threshold of 40%. Yep. As for our call itself, we downgrade to reduce. However, we raise our target price slightly from $80 to $100, and this is mainly because similarly the share price movement, and we increase the revenue, PATMI, and terminal growth rate by 4%, 1%, and 0.5% respectively to account for the higher Shopee and C-Money growth. Yep. That's all from my end. I'll hand over the time to Darren to present on Keppel.
Yeah, thanks, Iqbal. Yeah, I'll run through Keppel DC REIT's post-acquisition of the the Keppel DC Singapore 7 and SGP 8. So yeah, this picture basically sums it all up. So excuse me. So this transaction is split into 3 stages. So the first stage you can see that's in the blue box on the left, stage 1. So Keppel DC will pay about 1.03 billion for the 49% stake in Memphis 1. So currently Memphis 1 is owned by Cascaden, Keppel DC, and the Keppel Griffin. So the first stage will pay 1 billion, and that includes 49% of Memphis 1, which is the Cascaden and the Keppel Data Center holding stake, as well as the notes issue of Class A notes and Class B notes that basically will give them the 99.49% economic interest in the 2 data centers of SGP 7 and 8. So Memphis 1 is basically the vehicle that owns the SGP 7 and 8 currently. So that is the phase 1 where they acquire a 99.49% economic interest. And then in phase 2, which is on the left, the Keppel Griffin, Keppel DC will have the option to basically they have a call option to acquire the remaining 51% of the Memphis 1, which is the Keppel Griffin stake. And along with the 51% stake in Memphis 1 comes the remaining 0.51% economic interest inside Memphis 1. So that is phase 2. And once they exercise the call option for phase 2, then Keppel DC will own 100% of Memphis 1, which owns SGP 7 and 8. And as a result of that, Keppel DC, they will collapse the note structure and they will own the full interest in Memphis 1. So then there is a stage 3 where DC will try to extend the lease for another 10 years. So if they manage to get that, then they will have to pay another $365 million for the extension. So basically, all in all, to summarize this whole transaction, the first stage, which is the acquisition of the 49% stake, or rather the 99.49 economic interest in Memphis 1 and the 2 data centers. So that's the first stage, and the second stage, which is expected in second half of 2025, they'll acquire the remaining 51% or 0.51% economic interest. So once they exercise that call option and they own the 100% interest in Memphis 1, which owns the 2 data centers, then Keppel DC will start to apply for tax transparency. Yeah, so that is just the structure of how the acquisition is done. Yeah, next slide, please. Yeah, so for SGP 7 and 8, They are high-tech data centers where they can handle AI inference workloads, and they are also BCA Green Mark Platinum certified. So just a quick highlight on these two assets. So SGP7 is already 100% occupied and completed. So it has a WALE. So both SGP7 and 8 has a WALE of 15.5 years remaining. And if they extend the lease for another 10 years, which is the $365 million cost in stage 3, then the lease term will be extended to 25.5 years. So SGP8 right now, it just TOP'd only in August. So the tenants are still moving in and they are undergoing a fitting out process. So this is expected to be it'll take a while, maybe about a year or so. So SGPA is expected to be fully occupied by the third quarter of next year. Yeah, so both SGP7 and 8 they are already 100% fully occupied. Yeah, next slide, please. Yeah, so for this transaction, how it will be funded is by a private placement, which was which is done at $2.09 or $2.09. So this is to raise about 700 million Singapore dollars. So this private placement of $2.09 translates to about the amount of shares that will be added is about 15% of the current total share outstanding. So that's just for the private placement part. And then there's another 86 for every 1,000 existing units preferential offering, and that's done at $2.03. So and there's also a sponsor subscription that will be done at the private placement price of $2.09. So all in all, if you add these three together, it will account for almost about 30% more units as compared to the current total share base before the private placement. So this total funding is about 100 and a little bit over 1 billion, and then the remaining balance will be funded by debt. So the total transaction is about 1.4, almost 1.5 billion if you include the land extension. So the first phase and second phase will be done, that will be funded more for the equity fundraising, and the remaining lease payment will be funded by the debt. Yeah, so this transaction is basically, if you look at it immediately, it will be about 11.1% DPU accretive in the near term if you don't include the lease extension, because only remember in phase 1 and phase 2 they only pay 1 billion before the lease extension. So in the immediate near term, when they acquire the 99.49% interest, they will have an immediate 11.1% DPU accretion. But in the longer term, after they let's say they extend the lease, the land lease by another 10 years, they make the payment, and then the DPU accretion will drop to 8.1%. Actually, it will drop to about 6+% after the lease payment of the land extension, and then after they get tax transparency, then it will go up to about 8.1% DPU accretion. Yeah, so for that, the AUM in Keppel DC REIT in Singapore will rise to 65.5% from the current 53%. So that's a good time, because we've seen in the last 2 quarters, Keppel DC REIT, they managed some very strong positive rent reversions of 40% for their contract renewals in their co-location assets in Singapore. So currently, these two assets, SGP7 and 8, their current contracted rents are about 15 to 20% below comparable market rents, and they are also of the same vintage of the current rents that saw the 40% rental uplift in the past 2 quarters. So definitely, we think the rental reversions when the leases are renewed for these 2 properties will be very high as well. So there is potential for rental uplift from that. So on the right, they have the dates of important dates for you to note. So the launch of private placement, that was last week, the day after the announcement, and it closed. So if you want to have a share in the preferential offerings, you have to you have to invest in the shares by today, basically, because today is the last date that they are quoted a come basis. Yeah, and the record date will be 27 for that, and the listing of private placement shares will start next week. And from that, the opening date and time for the preferential offering will be on 2nd December, which is the week after. Yeah, so Yeah, just the dates are all there. So yeah, if you do not want to participate in the preferential ring, you probably have to sell off your shares today. Yep. Yeah, so that's basically the transaction. And for our target price, we no change our target price in the near term, 2.16. But after the private placement, because there will be a lot of new shares in the market, like 15% from current, we expect the target price, our target price will drop after the new issue to about $2.14. Yeah, I saw a question that said the Keppel DC current price, is it still a buy? Yeah, so we have a neutral here, so that covers the question. And basically the share price today rose by $2 to $2.30. That's mainly I mean, sometimes data centers they trade like, it doesn't make sense. Like we also saw past 2 years ago when there was a after COVID, there was the boom in the so-called the data center and tech. We saw Keppel DC REIT trading at like 2 over times book. So that also, yeah, sometimes the market we think is irrational, but for us, we think now Keppel DC is more of a neutral call. Yeah, so that's it for Keppel DC REIT's update with the preferential offering and private placement and the acquisition of this SGP 798. I'll now move on to the REIT Monthly. Yeah, so for the REIT Monthly, that basically we are expecting fewer rate cuts because of the Trump's policies are considered more inflationary, and inflationary is expected to be stickier with Trump. So now we saw in October or so the share prices of a lot of the REITs is all down, mainly because at that point in time the expectations that Trump will win were escalating and becoming higher, as well as the 10-year yield was also falling or rather rising. Yeah, so all these affected the REITs. So we see basically all the subsectors as well as the whole index was down in October. Yep, next slide, please. So for this, the 10-year dividend yield spread, it rose slightly because of the share price decline, as well as the fact that the 10-year yields, it rose a little bit. So it offset each other a little bit, and as a result, it's up slightly to 3.3%. Yep, next slide, please. And forward dividend yield as well is now trading about the historical average 10 years, and the price to NAV is still trading at a very high discount. So for us, we think that interest rate for most of the REITs have already peaked because they've already repriced a lot of their loans. And going forward, we think depending on the percentage of loans that are still remaining on fixed rate, most REITs will start to benefit from lower interest rates next year. Yeah, next slide, please. Yeah, so we move on to our subsectors. So previously we had an overweight on hospitality subsector, but now we drop it to a neutral. Now that's mainly because we think the outlook for hospitality, the growth has really slowed, and going forward next year, we expect a low single-digit growth as compared to the 2023 growth where we saw like double-digit, and in some cases like in Japan, we even saw 100% over growth in RevPAR. So looking at the numbers, international visitor arrivals, it's still growing. It grew 16.7% year on year in October. RevPAR is flat for the quarter, for the month. But the thing is, the RevPAR is still 29% above pre-COVID levels, and international visitor arrivals are still 14% below pre-COVID levels. So one thing we noted from a lot of the results as well is that there's a down trading trend where the tourists are spending less on luxury as well as the higher end hotel offerings. So the middle tier and to upper scale will benefit from this. So we see Fai's Hospitality, they're benefiting from this down trading with its balance and to mid to upper hotel offerings. Yeah. So next year also there will also be a lack of major events in the first quarter. Like we saw first quarter in 2024, this year we saw Coldplay and Taylor Swift. So that really drew a lot of foreign demand. And as a result, RevPAR in the first quarter in 2024 is very strong. So next year we think the outlook will be challenging, especially in the first quarter. But overall, we are still expecting a low single-digit RevPAR growth across the board in 2025 from improving occupancy as the average daily room rates have already stabilized. Yeah, but a good factor to note is that the visitor arrivals from China is still improving. It grew 91% year on year. Right now, it's still 9% below pre-COVID levels. Yeah, but the downtrading trend is really prevalent that we see across the board, even for retail assets as well. Yeah, next slide, please. Yeah, so for the retail, we still favor the retail segment because for retail, we believe that there's a strong potential for positive rent reversions. We saw suburban malls have rent reversions of about upwards of 5%, around 5 to 10%. So that is high single digit. And downtown malls having high rental reversions of double digit to low 20s. So really this trend can continue. And that's mainly because we see a lot of demand from overseas retailers, new F&B concepts, and also there's a shift to entertainment and wellness to support all this rental growth. And the big factor right now is that tenant sales are still trading above pre-COVID levels by about on average 20%. And that as a result, the occupancy cost is still low and is still below the historical pre-COVID averages. So there is still potential for rental growth. But on a backward-looking front, the tenant sales have really slowed. So we see some tenant sales really negative year-on-year growth. And especially the worst hit are the luxury products where the tourists are also spending less on luxury products. So that is affecting tenant sales. But the thing is that because of the low occupancy cost and the limited supply of new retail space, there is still potential for rental growth despite the tenant sales slowing as we've seen quarter on quarter, and these retail sales we're also seeing year-on-year decline, like decline 1.4%. Yeah, so that's the outlook for retail. So next, I'll talk a little bit about office. So for office, in third quarter, a lot of the REITs that are office properties, they reported some good positive rent reversions, but that's mainly because of the fact that their passing rents are still below market rents, and when they mark those rents to market, they can get some positive rent reversions. But as a whole, macro like market front in Singapore, we think that the rents will come under pressure, especially from the new supply from IOI Central Boulevard, even though it's 60% pre-committed and expected to be about 80% by the end of the year. The IOI, they're still targeting the higher end of the market with rents about $14 and up, as compared to a lot of the other local REITs where their rents are within the $10 to $13 range. So we expect the vacancy to increase for the overall market, as well as the new supply from Keppel South Central, which is about 615,000 square feet of space that's coming to the market. So all this will increase the vacancy. So as a market, we think the grade A core CBD rents at 11.95 will come under pressure and will likely remain flat or even start coming down. But from the local REITs perspective, because their passing rents are still below market rents, we think there is still some potential for positive rent reversions, maybe in the high single digits. Yeah, so that is for office. And for industrial rents, especially for we saw prime logistic rents since the trough in the COVID period. From then until now, it rose more than 40%. So we think going forward, the potential for rent reversions, positive rent reversions will slow and likely slow to the single digit levels for prime logistic rents. For business parks also, it remains weak as the island-wide vacancy is still above 20%. It's at 21.4%. And we also noticed that there's some consolidation between major 3PLs and e-commerce firms. So as a result, the demand for space might come down. And there's also quite a bit of new supply coming into prime logistics space in 2025. So landlords will likely prioritize occupancy rather than trying to get their higher rental growth expectations. Yeah, so as a result, there's we see some weakness in the industrial sector, but we still expect maybe a mid-single digit positive rent reversions for industrials, for logistics, and for business parks, it will still remain relatively weak. For China in office, for industrial assets in China, especially the logistic market, there'll still be some weakness there, and we expect maybe another 2 or 3 quarters of double-digit negative rent reversions, and that's mainly from the new supply entering the market, increased tenant incentives, as well as some weak economic activity in China. Yeah, so the table here that you see in the slide is our coverage, and mostly have a buy call on a lot because on most of the REITs because of the share price correction over the past month or so. And this is also after the update of the third quarter business update. So we have moved some of our target prices as well. And the thing to note here is that Keppel DC REIT is the neutral that we have, and I spoke a bit about it just now. Yeah, so that is the change. Yeah, so that's all for me now. I hand over the time to Paul. Thanks.
Yeah, thanks. Thanks, Darren. Move on to Oiltek. Go back to the title. So for Oiltek, they provided a third quarter update. They are executing ahead of our expectations, at least on the earnings part. Next slide. So in terms of Oiltek, the only numbers they gave was those that you see on the left here. So there's revenue up 14, then the profit is up almost around 80%. The numbers beat our forecast, and we so one of the positives was been the jump in gross margins. So I think you can see here from almost 30%. But do know that when it comes to gross margins, some of the drivers was better geographic mix because they get better margins in overseas market. That means outside of Malaysia and Indonesia. But there's the usual operating leverage, purchasing scale, because once their revenue goes up, they actually source a lot of materials from suppliers. As you recall, the model is that they don't have their own factories. They tap on the supply chain in Malaysia. So with scale, they can get cheaper raw materials. The third thing, this is not unique to Oiltek. This is probably for any construction company or any project-related company. Sometimes you have a pop in margins when the project completes. So what happens is that okay, this is more like accounting teaching, but when it comes to project accounting, you usually have to assume a certain project margin. So let's say you assume 10%, usually you have to be conservative. Then when the project ends, the margins are usually better than what you initially forecasted. Then you have to adjust it back up. So usually you get a bit of higher margins at that tail end of the projects. So sometimes it can be volatile quarter on quarter. The revenue was behind our estimates, but they have about 400 million of order books to support it. So we raised our earnings by 11% because they're still running ahead of forecast. We raised our gross margins. We also moved our Sing dollar assumptions. We were using 3.5, so we just adjusted back to 3.3. The reason why you get the rise in the target price is because we changed our valuation. We used to give it a discount to the peers. So the peers now are trading at 22, so we just move it up to 22 times PE. The peers were mainly engineering peers out of Malaysia. As usual, Malaysian companies always have better valuations. And also because there's momentum in the order book and momentum in the earnings. So we're still bullish. I think we believe the demand remains robust. So some of the drivers will be the increased capacity in oil palm refining. So what happens is that in Latin America, you see a lot of palm oil planting and palm oil production. So once that happens, you need to refine all those fruits that has been harvested or palm oil fruits. So as a result, you need higher refining. Fractionalization means after you get CPO, you want to value add on it. So you want to make it to more valuable items like cocoa butter, margarine, or so forth, or palm oil and so forth. So what that happens is that you need to add fractionalization. So that is happening, I think, not just overseas, but even in Malaysia and Indonesia, that is a continuation. And some they are more aggressive. They want to even improve further their processes, especially in the biodiesel. So what they're going to do is they will actually add in the biodiesel that some of it can actually make into vitamins. Yeah, it sounds like science fiction, but actually that's how they can do it. There's vitamin A and also vitamin E. So this is the value add. And the next one, the final one will be not on the slides, but their push into sustainable aviation fuel oil. So that will be the big one that we are hoping that they can get. So we do still see a continuation in order books for Oiltek. Next slide. I'll move on to ST Engineering. So the revenue momentum's intact. Why we mention revenue? Because the third quarter update, they only provide a revenue number. So this is what you see is what you get. So that's all they give, that's revenue and some order books. So the revenue is about 14%. Most of the growth came from that line item called defense and public security. So just to recap, for ST Engineering, there are three parts to the business, but the main ones is commercial aerospace. So inside commercial aerospace, what they do is maintenance of aircraft. They also do passenger to freight conversion, means those old aeroplanes, commercial aeroplanes, then they convert it into freighter planes because can't be used for ferrying passengers. They use it for freighters, and as you know, freighting demand for cargo now is very strong. Then they also have they build engines for Airbus, the nacelle part. That means like the cover of the and engine planes. And for of course they have defense. Defense is I'll explain a bit later. But anyway, the numbers was within our expectations. The revenue, the defense revenue jumped strongly, mainly because one thing they realized that despite all the advancement in technology, I think a lot of countries realize that in a real warfare situation that we see right now, there's a lot of conventional weapons used and ammunition. Convention can be pistols, can be the 40mm shells and so forth. So that's where they're getting the growth. And they're less known is they also do a lot of cybersecurity. So they are specialized in a lot of utility like cybersecurity, and not so much like a corporate firewall. They're mainly into the transportation, electricity grid, those type of cybersecurity. So the demand is also strong there. The negative is Satcom. So this has been a negative for the last few quarters. So inside that USS Urban Solution was TransCore, which they do like ERP. Like New York is implementing congestion pricing, which is basically ERP. So what they're doing, the one weakness for them is the Satcom business. You can see the -5%. So Satcom is facing competition, especially from Elon Musk settling. So they actually have to revamp the whole portfolio. So there's a big revamp of the products that they're doing right now. So they're still in restructuring mode. One positive is that they are actually very aggressively cutting down headcount, I think as much as 20%. So, but then the results won't be seen until hopefully maybe next year. We did move our numbers a little bit because we think the margins at the commercial aerospace will be weaker than expected, because even though their utilization of their hangars now is 90%, they don't seem to mention much about pricing power, and they're also facing labor costs. So we're just a bit worried that there could be margin compression there. But again, for ST Engineering, the growth drivers are still intact. I mean, there's demand for aircraft maintenance, growing defense budget, rising cybersecurity cloud, and also the adoption of a new urban transport. So they actually secured a big contract out of New Jersey. Mainly is their back end system for their current for the current train system. It's more like the back end system. They won a US 1.7 billion contract. But it's not in the order book now because the previous contractor is filing some complaint in the US, which is quite normal. So until when that happens, then they will add that back in the order book. Move on to the next slide. So move on to ThaiBev results. So go back. So the ThaiBev, the fourth quarter we saw a rebound in volumes, but now beer becomes less relevant. I'll explain why. Next slide. So for ThaiBev, the results was within expectations. There was a volume boost. So you will notice here there are two charts here. So one is just the fourth quarter. I usually try to take the latest quarter, so at least we can get some momentum of the numbers, although they don't actually separately disclose fourth quarter. So I had to kind of compute it myself. So there was a boost in revenue because volumes rebounded, but the margins was exceptionally weak. But they are guiding better margins. You'll notice the margin contraction. So even though revenue went up, EBITDA was down. But they are guiding better margins because the raw materials, which is mainly molasses, they use for spirits and so forth. Technically sugarcane. I mean, so that is basically the pricing is down 10-20%, but you get the benefit maybe only in their second half of next year, the financial year. The negative is rising interest expense. Why I'm just flagging this up? Of course, they got more than sufficient to cover. It's not like some big issue because they generate, I think, 20 billion. Sorry, 4-5 billion. But let me get the number again. But their cash flows are strong. But just that, they still want to go ahead with their beer co IPO because they need to deleverage a bit. So that's why I'm bringing this up, because the leverage is still climbing up. Interest expense is outpacing their earnings. But they never mentioned. So Beerco catalyst, not clear. I mean, this has been supposed to be a catalyst for the last 2-3 years that they always talked about. But the Beerco is either IPO or could be a strategic stake sale. So that's something to watch. In terms of outlook, so one thing to note is that just to dial back a bit for everyone, if you remember, ThaiBev also owned Fraser's property, like 28%, and also around the similar levels for FNN. You know, the FNN that's listed on the SGX. So what they did with the parent is that they swapped the property for more FNN. So their FNN stake go from 20% to about 70%. So what happens post share swap? So if you look at that bullet point, what it means is that ThaiBev is a bit positive because they won't have the swings. So, if you own a property company, you got fair value gain, fair value loss. Sometimes then you got development project. Sometimes you have earnings, sometimes don't have earnings because development. Sometimes you have development projects and so forth. So you will remove the lumpiness, the volatility from property. In exchange, you will get more stable beverage earnings, non-alcoholic beverage, they call it. If you look at the chart at the bottom here, non-alcoholic beverage. And that will include Vina Milk. So FNN owns an associate stake, and most of the earnings actually come. So in the end, right now, the new ThaiBev will be less property but more milk and non-alcoholic beverage. So when we say less relevant beers, because I think non-alcoholic beverage will jump to almost 15%. You don't see it right now because there's a bit of accounting anomaly. You can read from the notes if you want, but non-alcoholic beverage will be even bigger than the beer business. So although everybody talk about Chang Beer, Sabeco, but the FNN will be a bigger contributor to earnings moving forward. We raised our target price a little bit, but the problem for ThaiBev as a share price is really the de-rating. So the valuations for ThaiBev used to be 18 times, then dropped to 16 times, and now dropped to 14 times. Our target is trading at 12 times. So because there hasn't been much growth, so that's why you continue to see this big de-rating for ThaiBev as usually consumer stocks trade at the higher valuations, but not these days. Probably semiconductor stocks the one that gives the better valuations. Yeah. Next slide. Okay, I'll move on to the usual weekly. So our weekly, there wasn't much on the US news, but from Singapore, we got some export numbers. We're beginning to see it declined 5% in October. But across the board, I think, like we highlighted before, I think we do see export sector, a soft patch is underway. I'll explain later on the charts, but basically, I think after the restocking in the US, I think we do see exports slowing down. For RMC, which is this is the Pan-New Hong Leong Asia chart, you will notice that the volumes are still strong. It's up about 7%. For the third quarter, it's up 9%. So this is still demand still remains very strong for construction. On the steel bar side, it's volatile. It's up 60 and down, but generally the third quarter has been soft. So you saw a bit of it in the BRC numbers, and I think BRC did highlight that in November you could see a bit of slowdown in November, because if you look at the newspaper 2 weeks ago, the authorities basically asked for voluntary timeout because there's a lot of accidents at the construction site. So they actually asked some construction companies to slow down, but it's voluntary, or maybe just relook at your procedures. It's not bad as last year. If you remember, last year there was actually almost like a forced timeout. So right now, because of the accidents, they say, can you relook at your procedures, slow down a little bit virtually? Okay, then the last bullet point here, average monthly earnings. So this is basically the salary growth of CPF contributions. So what we do see is that the salary is actually coming down 4.4%. So this is the slowest in 11 quarters, and this obviously won't be good for retail sales. Next slide. Well, for our tactical views, we of course the big news is always on NVIDIA. So we just wanted to highlight that we think there'll still be one more ramp up in demand for NVIDIA because there's such a huge performance difference between their new Blackwell chip and their old Hopper or the H100. So on the chip alone, there's like 4 times faster. But if you look at the server speed, that means if you combine all these chips, because now a huge server rack, then you look at those like big computer that's almost like a person's height, right? Inside there are, I think, 72 GPUs. So when you compare that to the H100 stacking, it's at least NVIDIA claims it's 30 times faster. So one of the reasons is not only the GPU chip, but the innovation that they have is this NVLink switch, is the ability to communicate at an extremely fast speed between all the GPUs. So anyway, the key point here is that there is a reason why a lot of the hyperscalers are holding back. There's pent-up demand. Because why do you want to buy the older H100 chip, which is like, I don't know, 30 times slower, like, in a way. So that's why we think there could be one more ramp up in demand, then after that will be slower, it will be slowing down. I mean, this is probably just the key message I want to put in, because why would I want to spend now when you're going to get this new server rack that's 30 times faster? So that's the key point. So in terms of the impact to Singapore's semiconductor stocks, we are cautious. We think the fourth quarter numbers won't look good for the Singapore semiconductors. In part, mainly because last year, I'm talking fourth quarter 23, there was very strong numbers. So I will explain a bit later, but Franken had a few one-offs, not extraordinary income, but one-off in terms of pricing. I'll talk about it later. Likewise for UMS. So UMS, if you recall, fourth quarter last year, there was a lot of pull in orders. So because for UMS, they have a deal with Applied, and if you buy more, you get more discounts. So last year they tried to pull in the orders forward so that they can get the discount. So that's why for fourth quarter of this year you might not see such good numbers. It's the opposite for AEM. Sorry, it's a bit confusing here, but for AEM is actually a positive. So their big customer Intel is actually pulling in for fourth quarter of this year. So you will see some better numbers, but it's already in the guidance. So I don't think it will move the share price too. But anyway, so we're just cautious in the near term. So in terms of the medium term or the longer term view, semiconductor demand has been doing well. You look at all the semi or sales going up, but a lot of it is all on GPUs. One chip can cost 30,000, but the problem is this is low value but very high, low volume but very high value. So for the semiconductor industry to recover, you need edge AI. So because after in 2022, a lot of the equipment was ordered. So they ordered a lot of equipment, but then the utilization rate was so low because there wasn't much growth in phones and smartphones, and PC didn't grow. So what the whole industry is banking on, I think we talked about it before, it has been edge AI. That means you want AI features in the phone so that you make everybody excited and everyone upgrade. So that's why we monitor what's happening in Apple Intelligence, provided it is launched. But based on the review so far, it's been quite disappointing. So if you recall, Apple talked about AI in the phone 6 months ago, and I don't think it's even been in the phone yet. But anyway, so far some of the early reviews has been quite disappointing. So one of it is an AI writing tool. It's almost like your ChatGPT. They just embed it inside the phone. For your photos, you can remove photo bombers, I guess, and also you can, I don't know, point at the dog and then just say, what kind of dog breed this is. That's one of the examples. So we don't think I'll make the emoji a bit cuter. So we don't think these are killer apps. You probably maybe use this 2 or 3 times a year. And that's why we don't think, we are a bit cautious on the semiconductor cycle because everyone's talking about a recovery in the second half. So we are a bit cautious on that because there is really no killer usage to upgrade your phone. I mean, apart from better memory now, I guess. The one that to watch for that could really cause users to upgrade the phone is one thing talked about on what if they upgrade Siri in Apple. That means inside Siri, you actually can control other apps. you can maybe control Excel, you just talk to Siri, you know, move this, do that. So that is one of the things everyone's watching, whether that could be the killer app. I know, sorry, this is a very long-winded thing, but we have to monitor this closely so that we don't miss the cycle. Suddenly there's a big upgrade in the phones, but that's something that we are watching now. Okay, anyway, enough of that. But so in terms of the events coming up, the main one will be the US, the core PCE number coming up. So if anything, we think the number will still be hot because of last year was exceptionally weak. So we think if it moves around 2.7, then I don't think there'll be any change in the Fed expectations. Yeah. Tomorrow we have a Centurion webinar. So if you want to know what's going on with student accommodation, what's happening in the construction sector, no, do dial in for it for tomorrow. And then on 3rd December, we will have, you want to know more about oil and gas, then do dial in, but that's much later following week. Yeah. Next slide. So for this, this is just to show there's a big drop in the electronic exports. So it's not only exports, but also we see a drop in exports for electronics. And this is a 3-month moving number. So this is not like volatile. So this is a smoothed out number already. Then if you take the whole Asia as combined, if you look at take in Taiwan, take in Korea, we do see a bit of slippage right now. Next slide. Then if you look at nothing much, this is just the demand for ready-mix concrete. You can see that it is hovering around the 8-9%, so still healthy. The bottom one is just I guess everyone's pay now. The growth rate is slowing down. The blue line. Next slide. And last 2 slides. So this is just a feeling on the ground. We just from the analyst briefing, we just want to give you some key highlights. So the earnings was strong. It was up 30%. So they are trending. If you look at the PAT line, they're trending around 9 million per quarter. But if you notice, 4th quarter of last year, they hit almost 13 million. But let me just run through. So the major lithography customer, which I think everybody knows, is ASML. So the stock took a hit because of ASML guidance was just flattish. But according to them, they are not really impacted that much because they are focusing on their ASML's higher end, their new EXE EUV product. So this is the higher end, and these are the high end products that is used for producing your GPUs and HBMs. So, and there's still a lot of backlog. So that customer is not an issue for them. And also they are securing more projects because that customer is facing supply constraint in Europe, and they're moving their older product production into Asia. So they're doing well for that. They also have a new customer, which we think is applied material. So the demand for that is also doing well. So for Franken, I think the semiconductor demand for them is still strong because they are focused on front end. Other parts like back end, semiconductor, auto is still soft, but just that 4th quarter may face a high base because 4th quarter 23, sorry, it's a typo here, not 24. They had this MPI claims, there was repricing for inflation. So all this fall off, go straight to the bottom line. MPI means new products, so they're developing new products. Then the customer will just give them, they can bill the customer for new product engineering work. So for us, you just have to get through the weaker headline numbers for the 4th quarter 24. But valuations look quite reasonable. I mean, they're looking at 14 times PE, and if there's any weakness in the share price from the weak 4th quarter, I think probably there could be opportunity. Yeah, and one thing to highlight is that they kind of warn that everyone is hyping. There's always this hype about more manufacturing coming out from China, the China Plus One. But what they said was that even though this is a good trend, but the problem is they spend a lot on capex and the volumes drop. So they're not getting any of the benefit right now until volumes picked up. So I guess this is probably an interesting point. Yeah. Next slide. Okay, sorry. So this is my last slide. This is on First Resources. They didn't report last year, but last week was the week before. Just that I didn't have time. But just to give you some flavor, the earnings was up 20% because the selling prices were up. I think selling CPO prices was like a 5-year high. Their production is still strong. They're actually doing better than industry. I think industry is like double-digit decline, but they still managed to grow. Their costs didn't go up. They're still within the guidance, and CPO price at 1,001. So they still earnings very good margins. And in terms of weather conditions, no real impact, like nothing unusual. A lot of the talk was on biodiesel from Indonesia. They're moving from B40 to B50. So just to give you some so from their view, the recent jump in palm oil price was because of the Indonesian government's push towards B50. Prices went to a 5-year high, about ringgit, I think 5,002. But the problem for B50, if they do it in Indonesia, is the funding, because it's a bit complex here. But what happens is that the government has a fund called the BPDP, which they use this fund to subsidize biodiesel. So where this money come from? This 2.5 billion fund is from the export levy. So they will take some levy from the exporters, and then they will put it into this fund to fund the biodiesel. So the problem now is that if they do B50, it might cost the government subsidy about 8 billion Sing dollar. I mean, I just do my own calculation. Then compared to the fund now is at 2.5. So the fund needs to be topped up, or they need to reduce the consumer subsidy, because biodiesel is still subsidized in Indonesia. But anyway, this is just for your information. The share price has been weak recently because palm oil prices come off after the pop in palm oil prices because of biodiesel. The palm oil prices have been down, and mainly because of weaker exports and weaker soybean prices. But year on year, the palm oil price is up 27%, and it should be still supportive for their earnings at least. Okay, I mean, just for info purpose. Yeah. Thanks everyone. I think we can move on to Q&A. Yeah.
Yeah, thanks, Paul. Yeah, maybe I wasn't clear in my presentation. Mary, can you go back to the slide on the Keppel DC, please? Yeah, maybe I was all over the place. I was trying to explain the Keppel DC transaction. Next slide. Next. Yeah, the last one. Yeah, okay, so there are many questions. Okay, so I'll run through the first one. So Keppel DC deal phase 2, once go ahead to acquire the remaining 51% additional EFR, is it needed? Yeah, so no EFR is required for the call option in the phase 2 to acquire the 51% in Keppel Griffin, as well as the 0.51% remaining economic interest. Yeah, because the payment we estimate is only about 5 million for that phase. So yeah, no EFR needed for that. Okay, then the next one is yeah, sorry, I missed some part of the Keppel DC discussion. Do you mean that existing shareholders should sell the holdings if not interested in the subscription for fear of dilution? Thanks for clarification. Yeah, okay, so yeah, I got my dates a little bit mixed up during the presentation. So if you want, today is the last day where the advanced distribution will trade. So if you basically you have the shares tomorrow, or rather, so today is the last day the shares will trade come D with the advanced distribution. But the preferential offering, the record date, that means you will be entitled to the preferential offering if you have the shares on 27 November. So if you sell, let's say you sell your shares after that, you'll still be entitled to the preferential offering. You sell your shares on 28 October. But if you sell your shares today or tomorrow, you will not be entitled to the preferential offering. And one thing to note is that those private placement shares of the new units, they are also not entitled to the preferential offering, neither are they entitled to the advanced distribution. Okay, so what do I mean by if you sell your shares? Okay, let me try to answer this question. Why need to sell our Keppel DC REIT shares today if we are not taking a preferential offering today? Yeah, okay, so it's not today, it's by the date here, 27 November. So okay, so if you still have the shares, you definitely in our view, you have to take up the preferential offering, because if you don't take up, you'll definitely be diluted as the share price will adjust accordingly to the 2.03 preferential offering price. So now today the share price rose by 6%, and if you do not want to subscribe to that preferential offering, you basically have to sell today, because if you do not sell within the next 3 days, you have to take out a preferential offering. If not, you will be diluted by the preferential offering, because when the shares start trading at 2.03, definitely the share price will come down. So okay, so I've answered that part. of the question. There's another why I need to sell shares today if not take out. Yeah, so I explained that already. Okay. Do you mean existing shareholders should sell the holdings if not interested in the subscription for fear of dilution? Yes, correct. So I've also answered that. Okay, another one is, sorry, I don't understand about the Keppel DC offering. Once the offer of $2.09 is activated or issued, will the share price go down and is expected to drop by which date? Yeah, okay, so if you take a look at this table here, the listing and trading of the new private placement shares, the new units will start on 28 November. So that means that about 15% of the current existing share base, or about what's that? About 335 million units of new shares will enter the market at $2.09. So definitely because of that new 300 over million, which accounts for about 15% of the current outstanding, definitely we believe the share price will fall as the preferential offering price is only $2.09 compared to today's $2.30 something. Yeah, so that is what we mean. And to drop by which date, we expect it to drop on the date itself that the shares start trading. And there will be a overhang, share price overhang from that new issue of units, as we mentioned in our original presentation. So does it make sense to sell the stock now given the run up and buy back once it drops? Yeah, so our stance now, we have a neutral call at $2.16. So our stance, okay, if you base on the last price of $2.30, our call actually will be reduced. So yeah, that actually is our stance to sell the stock now. Based on today's share price, because it rose 6%. And then given the run up and buyback once it drops, yeah. So it really depends on how much the share price drops and what. So that one I really can't give any advice for that.
But Darren, you remember? I think you mentioned before the listing of the private placement shares is only on the 28th. So 28th, right, of November.
Yeah, correct.
Yeah, so once 28 happens, you can just imagine there'll be a lot of shares coming, and this block of shares is so much cheaper. So for me, it don't make sense not to sell now, I guess. Yeah.
Yeah, correct.
Right.
Yeah,
Yeah.
especially since the share price today already ran up 6% to $2.36. Yeah.
Yeah, there'll be 700 million worth of shares at 209. So I'm not sure who wants to. So you can imagine, although they are long funds, but long funds also know how to sell shares. So yeah, it's just for us to. We're just trying to highlight the worry we have that once the placement shares come out and we got such a huge margin, they are just their holding period is only like 2-3 days, or less than a week. We just worry there'll be a lot of selling on that day once the placement. Right, Darren, I think that's what was you told me.
Correct.
Okay.
Yeah,
Thanks.
And 8, I think. Yeah, is this a similar situation in the Parkway Life where the share price dropped above from $4 to 263 and now it's below offer price? Yeah, we think might be a similar situation there. Yep, and there's another option also. I believe there's a question there, but I'm not sure where it went really, is to not take up the preferential offering and not sell. Yeah, so I think that is the worst option that you can do, because you'll be diluted by first the private placement, and then when the preferential offerings, the shares start trading. If you can see the table on 18 December, you'll be diluted a second round from the preferential offering new shares that are issued into the market. So that is like a double dilution. Yeah, and that is not considering the sponsors subscription units that will start listing in early 2025. Yeah, so I hope that clears up the discussion on Keppel DC REIT. Okay, how many percentage of Ascendas and Mapletree Industrial is in data center? Yeah, so Ascendas is about 8%, Mapletree Industrial about 50 over 54%. Mapletree Industrial data centers mostly in US. So is Keppel DC REIT current price presumably less than 4%, you still buy? Yeah, we have a neutral call Yeah, but like I mentioned, after the 6% share price run up today, our call would have dropped to a reduce. How's occupancy for Mapletree Industrial US portfolio? Yeah, it's about 90%. It's a US portfolio doing well. Yeah, so they have some leases that are due for renewal, and they'll be up soon, like the AT&T lease for instance. So yeah, there's going forward there might be a little bit of weakness, and rental reversions also might slow in the US to mid-single digit. That's our view. Yeah, that's for the Mapletree US portfolio. The profits between overall logistics and data center, yeah, it's about 50, 50, 50. And most of data centers in US, yeah. Mapletree most in US. There's a question here. Does the deal benefit Keppel Corp? Why only 280 million out of the 1.3 billion price? Yeah, I think that's because of the share. Yeah, I didn't really see that. Yeah, let me try to see that from the response perspective and get back. Can you rerun the first page of Keppel DC on the process of share placements and preference shares? Sorry, first page. Do you mean my slides, the first page? Can you rerun on the first page? Yeah, but this page doesn't really talk about the process of share placement and preference shares. But if you want me to run through, I can. Okay, so let's run through a quick one again. So, basically, what happens here is the first stage, stage one, Keppel DC will acquire 99.49% economic interest in Memphis Fund, which holds SGP 7 and 8. Yeah, this is mainly through the note structure. So they'll after stage one, they'll own 49% of Memphis Fund, but because of the note structure, like the new Class A notes and Class B notes, they will have a 99.49% economic interest. And the remaining 51% stake of Memphis One that Keppel Griffin owns, yeah, that comes along with the remaining 0.51% economic interest. So after the stage two, where they likely they'll exercise a call option to acquire the remaining stake, which comes with a payment of about $5 million in our estimation. So they will own 100% of Memphis One, which owns SGP 7 and 8. And then they'll collapse the note structure that was created in stage one. And then they'll own 100% interest in Memphis One, and they can start applying for tax transparency. Yeah, and in stage three, that is after they own that 100%, they can start applying for the 10-year land lease tenure extension, where it comes with about 365 million of payment. Yeah, so that is the first page. So yeah, the process of share placement and preference shares, that's just to raise funds mainly for the stage one. Oh yeah, and one more thing I forgot to mention is that all this is still pending the EGM. They have not announced a date, so it's still pending a shareholders approval during the EGM. Yeah, so that's the rerun from the first page of Keppel DC transaction. Hi, Keppel DC REIT, if we sell tomorrow onwards, would we still be entitled to preferential offering as T+2? Yeah, so if we sell tomorrow, you will not be entitled to preferential offering. Yeah, so I'm sorry. Okay, turn back to the page 3 of the. Yeah, so you see here the preferential offering, the record date. That means the record date that's entitled to the advanced distribution. That's the fourth box in the event column. So the record date and the entitlement to the advanced distribution and the eligibility to participate in the preferential offering. So that the last date will be 27. So if you sell on if you sell tomorrow, you will not be eligible for a preferential offering. And if you sell on basically if you sell on 27 or so, you will not be eligible. Yeah, correct. Yeah, I'm getting confused also. Yeah. Yeah, correct. So, how we sell tomorrow, will we be entitled? Yeah, so we sell tomorrow, you will not be entitled to the preferential offering. Yep. Your T+2 record date, that one is more for the advanced distribution. Yeah. Yep. Okay. I hope that answers that question. Yeah. Hand over to my colleagues. Thanks.
Thanks, Darren. I'll take some questions. There's a question directed to Helena. Hi, Helena. May I have your fundamental view on Shopify? Yeah, so I cannot answer on behalf of her. So if you have any burning questions on Shopify, you may send her an email or you can direct this question on our Buoyant Street app. Yep. Okay, there's a question on NVIDIA. With NVIDIA's current dominance in AI chip, how quickly could rivals like AMD or new entrants erode its market share? And what's NVIDIA's next big product cycle after AI? I think this is a very good question because there's because NVIDIA is currently the clear winner within the GPU space. And right now, in my opinion, how quickly could new entrants take away this kind of market share? From my opinion, it really depends on how good the new entrants products are, firstly. How low they can price their products and how good is their ecosystem. I think it comes down to these three factors. Because right now, within the data center space, the main source of revenue is from hyperscalers, and hyperscalers are upgrading their AI cloud capabilities to capture cloud service opportunities from the Gen AI startups. And these Gen AI startups, which are their customers, they really want the most advanced kind of system which can deliver the fastest kind of AI AI insights. So if rivals such as AMD or new entrants come into the space, they really have to match NVIDIA's performance in terms of the AI, which is one of the metric is that measured in teraflops, like how fast the AI can process the information. So as what Paul mentioned just now, NVIDIA's new product, which is the Blackwell, can actually deliver 4 times the performance as compared to their previous product, which is Hopper. And right now, NVIDIA's MI300X is almost in line in terms of performance with Hopper. And right now, NVIDIA's new product, which is Blackwell, can deliver 4 times the performance. So if you talk about how quickly rivals can rival this kind of space, it really depends on what kind of products they launch. And they also have to definitely pump in a lot of capex in order to match this kind of performance to NVIDIA. Yeah, so I think actually right now Hopper still has an edge over AMD's MI300X because Hopper's ecosystem is much seamless and it's many more developers, millions of developers are using Hopper as compared to AMD's MI300X. And I think this is also another factor which the Gen AI startups may consider because they want their software and their ecosystem to have additional support. Yeah, so for a new entrant to take over NVIDIA's market share, they really need to they need to come up with a product that outperforms NVIDIA's in these areas. Yeah. And the second part of the question, what's NVIDIA's next big product cycle after AI? That one we really have no answer to that because right now the visibility we have is until Blackwell. So beyond Blackwell, we will continue to track and see what kind of products they have after this wave. Yeah. Okay. There's a question on given Sea Limited's shift from aggressive growth to focus on profitability, how sustainable is this strategy and what are the risks of losing market share to competitors like Shopee's regional rivals, Lazada and Tokopedia? Um, I I um I can't really answer this question like because I don't cover C personally. I think Helena will be in a better position to answer, but I can give some insights. So I personally do feel that this strategy is sustainable because after Shopee pump in the money for sales and marketing spend, and they actually became profitable from it. So in a way, it shows that they have captured a lot of audience, and from there they actually became profitable. So I feel that this strategy is a very sustainable one because we can already see profitability within Shopee itself. And there's also another point that after pumping in money to improve in their logistics, there's also there's that we can also see improvements in their logistics. So because for example they have over 50% of their Shopee Express orders in Asia being delivered within 2 days. Yeah. So I feel that this is the kind of competitive advantage they have after pumping in budget to improve on their processes. And I feel that this is kind of a sustainable strategy over rivals like Lazada and Tokopedia. Yeah. There's one more question on C Limited. C Limited has cut costs and scaled back on investments to strengthen their balance sheets. Do you see a risk of needing additional capital raises in the next 2 or 3 years? That one, sorry, I can't really answer that question. So I think could I trouble you to direct this question to Helena, maybe through an email or poem sheet app. Yeah, I think she'll be in a better position to answer. One question on Hong Leong Asia and BRC, I think. Oh yeah, correct. Why did Hong Leong Asia invest in BRC? Is there a synergy between both businesses? I think short answer is I think there's some synergy between both businesses because Hong Leong Asia's main business is in RMC, which is the ready mix concrete, and BRC is within the steel manufacturing space. So they decided to invest in BRC because they think that um, there's synergy within the building material space because both steel and concrete is within the building material space. And they did give an example, for example, in their prefabricated facility, whereby concrete and steel reinforcement solutions have to work together in order to come out with the prefab solutions. For example, I visited a company's factory warehouse, and it is a prefab factory, and what I can see there is the within the prefab factory itself, the steels and the concrete are being meshed together so that they can create a unit of a building block itself. Yeah, so I do think that there is a synergy between both businesses, and yeah, so I hope that answers your question. Yep. Yeah, I think that's all from me. I'll hand over to my colleagues. Thanks.
Yeah, okay, thanks. Thanks, Iban. Move on to what's your view on Co's eco large holding in Oiltek? I think it's a stumbling block to improve the liquidity of Oiltek. I mean, they own 70%, then with other shareholders, that's the only issue. The liquidity is tied up. One thing that they could do, I mean, I'm not sure, but they could actually, if they do a dual, one way to release this block of shares is either you do a placement or you do some dual listing, hopefully in Malaysia. Then with that could be a driver to release more shares. Because everyone is just hoping to go to Malaysia for better valuations. So that is one thing. Yeah. So that's the only thing is how to release. It's also good that they release, otherwise the liquidity was still going to be quite big for Oiltek. What's your view on only getting 2-year license? The market seems not caring. Yeah, I think there was some earlier announcements that the license is tied to also the whole RWS development. I think to extend the license or to maintain the exclusivity of the 2 IRs, I think they mentioned that they're going to do this huge capex spending. So I think that's why the market's not particularly concerned that they will suddenly just lose this casino license. Although that 2-year was, I guess, probably like a yellow card just to warn you to kind of, I don't know, improve on their so-called compliance procedures. Paul, do you have a target price for AEM? No, we don't really have one, but our general view for AEM, it's going to be a flat year for them. Probably 20, my back of envelope calculation, probably 20-30 million in profits. possible. It will be recovery year, but it won't be as good as the previous years, of course. Because any growth that they get from their new customers, which is one AI customer, which I think somebody asked before earlier, that the whatever recovery you get from there, which the margins should be better, is going to be offset by the weakness they are getting from Intel. So my back of envelope, I think I'm looking at maybe 20 million profit for them in 2025. So 2026 will be the more interesting year for them. Yeah, that's my own view. How do you compare First Resources booming? Yeah, I think First Resources is bigger, of course larger. I mean, that's the obvious thing. But the next thing is they do more refining. They're more downstream capacity, and if I'm not mistaken, their plantation growth is actually also faster. Yeah. So you get the additional refining, and of course the geographically, I think First Resources is more into the Riau Islands in terms of their production. I think 70% plus. These are some of the differences, but I think the main one is the downstream. Hi Glenn, your latest view on the local treatment. Yeah, so Glenn is on leave. So most of our team is all on leave. So Glenn is also on leave. So anyway, the three banks we like UOB the most because what's going to come up. So there are a few things to watch for the banks. Number one will be the upcoming fourth quarter results. So the fourth quarter results, who can give the biggest surprise in dividends or share buyback, or most likely it could be between UOB. So UOB has probably 3 billion of excess capital. So how this come about is that what happened in the third quarter was very important, because you notice all the capital ratios for most of the banks jumped, but UOB jumped the most. It's a bit more technical because they didn't use much of the modeling for CET1 in the previous version. But anyway, so they got their jump was from I think 13% plus capital, if I'm not mistaken, to 15. So they want to bring down their capital to 13-14%. So if you use that 1% difference, you're almost looking at 2.5 to 3 billion. So, and they kind of almost explicitly said they want to return the capital. So we think the second point to note is that why the banks are doing well now is, banks make money either from lending money or from capital market activity. So right now, capital market activity is doing well. I guess that's why you get a lot of upgrades in SGX. I mean, maybe the better way to play this is on SGX. So on capital market activity, although it's a positive, but capital market activity is a bit volatile. I mean, it can be good one quarter, then weak another quarter. So that's why we still have a neutral. The third point to note is we have a neutral because we think valuations are almost there. Just that there could be still one more run after the fourth quarter results, because the results will be good and they're guiding it to be good anyway, and there could be one capital repayment. Then thereafter, we're a bit more cautious on the banks. So we think near term there'll be this big, not big, but there'll be at least some momentum in the fourth quarter and improvement in their dividends. Likewise for OCBC, but the problem for OCBC, they don't really guide much. They're always very hesitant to mention how much capital they want to return. So I think that's why the analysts are all a bit more cautious. I'm not sure why. I can ask their management. Yeah, they do things differently. Yeah. Okay. The next one. Okay. Does the deal benefit Keppel? Yeah. The deal does benefit, but at the margin, they think they get like a 70 million plus gain for Keppel Corp, and also they get proceeds about 100 over million of proceeds from the deal, because it's a consortium that own the thing, that own the data centers. The other benefit they get is the management fee, because once this is transferred to Keppel DC, they still own Keppel, so they still get the management fee of the data center itself, and also as a Keppel REIT manager. I mean, that's the best business to be, like fund management. So the AUM will also benefit, because I'm sorry, their fee management will also benefit from that. So, but it won't be like a big jump. It's not like the one, like you said, why only 280, because it was a consortium. If you recall, this was the same consortium that privatized SPH. Yeah. Do you know, because this was actually SPH assets, so you just kind of jump on the bandwagon. Do you know why AM share price have quite a pullback today? Sorry, I didn't see any particular news. I apologize for that. I didn't really go and check. any particular news on the big semicon names? Yeah, so sorry, I don't have an answer for you for that. Yeah. Paul, any updates on BRC? The last update was Peggy. Yeah, I think we did an update in the previous one. I think Yip Ban will be issuing a note right now. Before we issue the report, we can't really talk much about the target price, but I think some of the two highlights that we got from the BRC is that construction demand will still be strong. I think it's more worry of the demand more than supply, because they're already beginning to see all these bottlenecks appearing. Number one, and in February, the T5, I think we talked about it many times, but the T5 award will be coming up. So that could give some momentum to the whole construction industry, because some construction companies going to get some big fat Hong Bao draw before the thing. But I mean, most of it goes to China construction companies. But anyway, you could get some news flow in February, because T5 could be announcing award of contracts before Chinese New Year. I guess it's some Hong Bao draw again. But then the second thing is near term, like we mentioned, there could be some a bit of bottleneck, because the government said to slow down activity, maybe chill, like voluntary time out, no, like basketball, no time out, but voluntary, no. Yeah. So the third thing to note is that for BRC, just holistically, their market share is huge and it's very hard to replicate. Because to do this business, it's not about just putting money. You need to have sites, you need to have the space, and I don't think JTC is giving out land for people to store steel, to store hardcore steel. So that's not the value add that JTC is looking for. So even though there can always be talk of competition, but really in reality there's not much competition, because to compete you need land space, and no, BRC has 7 sites. So whoever want to compete also have to go unless they find suddenly JTC decide to allocate some nice piece of land for them to store steel, which I don't think that's going to happen now, because it's going to be a complete waste of use, and not much value add, just like a storage bin, a storage place for steel. So that's why as we joke about it, but this is really the real barrier that they have. That there's limited land sites for you to keep the steel. So that's why, but I think he will update with the report, and then we will provide you the details. Yeah, sorry for a long answer. TA, yeah, apologize. Zane is on reservist, so we can't. There's no TA for today. Yeah. Okay, some KDC. Hi, Paul. What's your view on PropNext going forward? Keeping in mind that the interest rate will be coming down at a slower pace. Yeah. I think the earnings will still meet our target, our guidance, but I think what they mentioned is that some of the benefits that you see now, that all the good property sales that you see now, you only get it in FY25, because the billing takes time. So and also so I think 2024 earnings will probably meet our estimates, but there is some momentum for 2025, so it's still positive. And like we highlighted before, is their, I think, 20th anniversary or 25th, so there should be some special dividends also. Yeah. I mean, that's on my own view. Yeah. CDL, what's your view on palm oil related sector? Yeah. We are kind of positive. The margins are strong, but this is a very volatile sector. And with Trump there, I'm not sure if there is any negative on China that might also impact palm oil demand. But I always thought that this was a very high margin business. Like you mentioned, their selling price is, I don't know, 1,000 US. The cost is cash cost is 300. So it's a very positive business, but it's just going to rally along with the palm oil price. So with palm oil price coming down, then I think this stock in the near term it should be under pressure. Yeah, because it really just moves along with palm oil price. Yeah. You mentioned Beerco will be IPO listed. Will existing ThaiBev shareholders be getting any dividend in specie from this exercise? Oh, okay. For this, I don't think so. Yeah. I don't think so, because they want to keep their stake. They don't have a very big shareholding in Sabeco. So I think it's more likely they will IPO some of their they will park their Sabeco stake, and they will park some of their Chang Beer stake into a separate entity, and then from there they will they will just get some of the proceeds from the dividend and then the dividend up. I'm not sure. I'm not sure. They could do that, but what it means is that they will dilute Thai Beverage stake. So I'm not sure if Thai Beverage want to dilute their stake in the beer business. I mean directly as the listco, of course the parent, because even if you give it to the major shareholder, he can't do much with that, or he can't equity account anything. So I don't think they will do that. I think most likely they will give dividends. They will take some of the gains they get and then just pass it as dividends. Yeah, because to dilute their stake in beer, I don't think Thai Beverage want to do that, because beer is already only 10% of earnings. You dilute more, then becomes almost like insignificant. But I mean, of course, this is just my view. I mean, I could be wrong at that. Yeah. Do you SGX website shows the consensus target price? Do you submit your updated target price? Okay. This one I'm not sure. It's an interesting thing. I never really even know they had a consensus target price. I will need to check on this. Yeah, I will. Yeah, sorry. Let me take this down. I need to check on this. I'm not particularly sure. I never even saw the price. What we normally do, because we got Bloomberg, so we actually look at Bloomberg. Actually, we don't look at the consensus price. We just look at some of the earnings. We hardly look at investors' target price. Yeah. I mean, other broking houses' target price. Looking at Singapore market, banks and SGX is run out. REITs move restricted by Trump. What are your compelling buys now? Yeah, you are right, I mean, in a sense, but I think REITs would be the one for me. I think some of the overseas REITs are like we've always mentioned, where the yield is still high. I know some investors don't like it totally. But the reason why we say so is because I think interest expense, like what Darren mentioned, I think interest expense for most of these REITs will come down, even if the Fed does nothing now, because most of their debt has already been repriced at a high level. And also, if you are in, I think the action next year will be in the near term will be in the US, because Trump alone is going to cut interest. He's going to cut taxes. He's going to sprout out there'll be like a sugar high in the US stocks in at least the first half of 25. Then maybe he'll do a deal with China. Then, as you recall, Trump had a deal with China, the phase 1 deal. So that could actually benefit the Chinese equities in the second half if you do such a deal. Again, I'm just speculating here. But in the near term, it's still going to be banks, I think. Yeah, that would be the one. But Singapore is only banks and REITs. So yeah, and technology probably second half of next year. Yeah. Okay. I'll leave the rest to Darren. I think some of them. Yeah. Okay. Thanks. Yeah.
Yeah, thanks. For why is digital core REIT price doesn't move much? Is there any baggage that's holding it down? Yeah, I don't think there's any baggage particularly that's holding it down though. Yeah, but for them, they have some good rental escalation as well, and so let me check my notes.
Yeah, just a quick one. I think like Mr. William Tay here mentioned that maybe AEM share price could be affected by the US cutting Intel grant. So I think again, just to address the question earlier, why AEM today? Thanks, Mr. Tay. He mentioned that it could be some mention of cutting of grants. Yeah, thank you.
Yeah, so they're renewing their lease in the LA property. So there's some good news there, because even though there's only 60% leased up, but the rents are already in line with previous rents. So for them, operational wise, is doing okay for digital core. So I don't really see much baggage that's holding it down. Yeah. CDL and CDL Hospitality share price keeps on dropping. Is it a sell, or what's the potential for it the next half? Yeah, so for CDL, we saw in the operational update that they're doing that the sales for the third quarter is quite strong, and their hotel segment is also doing well. And so is the investment property segment. But based on the discount valuation is just a very, very steep discount to valuation. So even if you don't consider the changes in fair value of investment properties and just the pure book value of about $10, they're already trading at 50% discount to their book. So we think that's it's cheap. CDL Hospitality, yeah, they're impacted by their RevPAR in Singapore. Yeah, so that is a little bit of weakness there. If I understand correctly, if a person holds Keppel DC shares after 5 p.m. on 27 November, then she is entitled to the preferential offering and advance distribution. Yep, that is correct. So if she sells the shares before that, then she won't be entitled. Yeah, so okay, so the X date for the advance distribution is today. So if you sell today, wait, okay, so the last trading date come dividend is today. So if you sell tomorrow, you will not be entitled to the advance distribution, but you'll still be entitled to okay, so okay, okay, sorry, getting mixed up. So today is the last day for the advance distribution come trading. So if you sell tomorrow, so if you sell today, you will not be entitled. So if it's tomorrow, you will still be, so if you sell tomorrow, you'll still be entitled to the advance distribution. But if you sell tomorrow, you will not be entitled to the preferential offering because the preferential offering record date is 27 5 p.m. Yeah, correct. That's correct. So I hope that clarifies. So if you are holding, if you sell today, you will not be entitled to both the advance distribution and the preferential offering. Yeah, hope that clarifies. Why is CLI price falling for? Yeah, I think that is because of interest rates mainly, and the fact that CLI over the past quarter, so after their 3Q results, so over the past few months they rose from about 250 to about 320, and then it fell from there. So I think the near-term headwinds are more interest rate related, and yeah, the Trump effect, I would say. So I think that is why CLI price fell from that 320 until now about 280, mainly because of the high interest rates. Please comment on ESR logo sheet share price drop. Yeah, they never really invite me to their investor briefing. I'm not sure why also. But I don't really have much comments, but I believe their logistics rents are still doing well. They have strong returns of about 11%, and their occupancy remains relatively stable. And for this quarter, they also saw some improvement in borrowing costs. Yeah. Yeah, I don't really have much input to add for ESR logo. So FLCT, any comments and put it outside from here? Yeah, so for FLCT, their industrial assets remain quite strong. Industrial logistics in Australia as well. The office business parks improving. Yeah, so yeah, with lower interest rates, we do see some improvement and some potential upside from there as well. For Keppel DC REIT, what's the theoretical exercise price after the preferential offering and advance distribution? Yeah, so the exercise price, theoretical exercise price for the preferential offering and advance distribution based on the VWAP, or the most recent VWAP, is about $2.18. So that's the theoretical exercise price. But if you base it on our share price or our target price, the post preferential offering and advance distribution, the price will be $2.14. Yeah, but just purely based on the VWAP of the previous day before the announcement trading or the announcement of the acquisition, the term will be $2.18. Yeah, I think there's one more question for Paul.
What about the
Hang on.
questions in the chat, Darren? Sorry, did you just want to
Yeah,
most
I
of it?
think those are I
Oh,
can
okay,
answer
yeah.
already.
This is very
The main
confusing
part.
thing. Yeah.
Yeah.
But in summary, you want to summarize for everyone, since I think
Okay,
like
okay.
what should they do? Because if you have it, if you don't have it, just for everyone's benefit.
Okay, yeah, sorry, Barbara, can you go back to the third Keppel DC page, yeah, just to do a quick summary, because I know it's quite confusing. The whole structure is also is not it's quite complicated. Yeah, so based on the trading today, so today is the last date that shares will be trading on a cum distribution basis. So that is a cum advanced distribution basis. So basically, if you still hold the shares after today, you'll be entitled to this cum distribution. If you hold the shares, if you sell the shares tomorrow, you'll be entitled. But if you sell the shares today, you will not be entitled to the advanced distribution, and you will also not be entitled to participate in the preferential offering. But if you still have the shares tomorrow, you'll be entitled to the cum distribution, and if you sell tomorrow, you will not be entitled to the preferential offering. Okay, so if you still have the shares, basically, if you sell on 27, you will not be entitled to the preferential offering. But if you sell on 28 November, you'll be entitled to the preferential offering. But yeah, of course, if you sell on 28, you will not be entitled to the advanced distribution. And so 28 will be a listing date of the new placement shares. And if you want to subscribe to the preferential offering, you have to take note on the dates. So 2nd December will be the opening date and time for the preferential offering. And you have about a week or so until the 10th December to accept or apply for the preferential offering and any access preferential offering if you would like as well. So that is by 10th December. So 2nd to 10th December is a application date. And the listing of the shares will be on the 18th of December for the preferential offering. Yeah, so I hope that clarifies the timeline for and what the you guys should do.
So is it in a way whereby to make sure to make you take up the preferential offering, they make sure that to get the preferential offering, you have to hold until to be entitled to the dividends, you need to you need to take up the preferential offering. Is it the way it's been structured, kind of?
Yeah. Because the date is after that. So you have to hold until after 28, or rather, until 27 to be entitled to the preferential offering.
Oh, okay. Yeah. Okay. But anyway, our general view is just to sell it.
Yeah.
Yeah, I think that's retreat. I think the placement is always a worry. The number once the placement, there's a huge amount of shares coming out. Yeah, once and everyone is having profit. Yeah. Okay. Yeah. Thanks for
Yeah,
that,
and
Darren.
one more
Yeah.
thing, we also think we should take advantage of the share price action today. It's really up 6%. Yeah, so we think it's worth to sell. Yeah, thanks, Paul.
Yeah. Okay. Yeah. So thanks, Darren. Let me just take on this last question. Paul, based on Phillip on the ground for Franken, is it a buy at current price 120 for this, and also your view of UMS since they intend to have a listing? Yeah. Okay. So we think it's attractive now, but like we mentioned, in the near term, we just Singapore semiconductor stocks always move on headlines, so we just worry the upcoming headlines when they release their results in February is going to be weak. So I think there's a lot of room to wait for that. Could be 120 or even lower. We don't have a fixed price, but we're just trying to say is that the near term momentum won't be there. Yeah. So there's time to be patient. To it could be these levels or even lower because there isn't any positive news coming up in the very near term. But if there's any sell down after the results, then it's worth picking them up, because I think the visibility for them on their semiconductor is strong, because they're doing ASML high end, and they also got applied as a new customer for some of the chamber, the disposition and etching equipment chamber. So that's our whole point. For UMS, we are a bit more concerned. I'm not sure if they list in Bursa, you get a big pop in the. I think Malaysian investors also not silly, right? They will see if you're value that way, because if I were to take UMS at the high price and these stocks are fungible, then the volume of shares from Singapore might move into Malaysia. So it's whether is the buying in Malaysia strong enough to pull the Singapore. So I'm not so sure, because there are alternatives. There are competitors there in Malaysia. There are other semiconductor names. Yeah. So my preference for me is really Franken rather than UMS in the near term. For UMS, the key one they're watching for is just the LUM Research, their new customer in Penang. how big is the momentum. So they are still hopeful, but so far volumes has been pretty weak. So again, this is more again something similar. It's more like the February, March. Any weakness, then there's a better bet. But just that for me, Franken, the visibility is better because the customers are already in and the ramp is underway. For UMS, the ramp isn't no visibility on the ramp. Yeah, it's just yeah. I mean, just my own view. That's why we prefer Franken, at least for me. Yeah. So thanks everyone for your time. Sorry, this is, a lot of the analysts are not around. I think because we're coming to December. But again, thanks everyone for your questions and for your time, and hope it was useful for you. And hope to see you again next week. And have a good week ahead, everyone. Thank you, and take care.